get you a CNBC TV18 exclusive conversation now from the sidelines of the JPMorgan India Investor Summit. Now we're being joined by Ankur Rudra, who's the head of APAC Telecoms and India TMT Research at JPMorgan. Ankur, always a pleasure speaking with you, and you've joined us at an opportune time, largely because there's so much which is happening in the telecom space itself, especially ever since, the Supreme Court verdict did come by. So in light of that itself, we'd like your thoughts first on, the industry as it were right now, and in that, your call on individual stocks, namely Bharti Airtel and Hexacom along with Indus Towers.
Hi, good morning. Thank you for having me. So, the telecom space in India definitely has been looking a lot more brighter over the last, couple of years. And what we are continuing to see this year is among the, several markets across Asia Pacific, India is one of the strongest, where we have seen, continuous telecom tariff repair and along with that ROIC repair, which bodes well for, many of the telcos, over here. And I think that is one of the key drivers of, revenue growth, EBITDA and earnings momentum that will move on for the next 2 or 3 years. I think one of the things which is sort of stark about India is we are seeing 5G capex build out is past its peak. The key leading telcos have already completed most of their initial peak of capex, and hence going forward, capex intensity will fall. Along with this, because of tariff repair, you'll see relatively strong growth on revenues and EBITDA also. So the combination of revenues going up and capex going down is quite positive, which is sort of making this market really stand out. If I look at telecoms across the world and across Asia, India really stands out in that on that regard, and hence looks a lot more attractive. I'm sorry, I will not be able to talk about individual names, but on an overall basis, we definitely find is very attractive.
All right. Hi, Ankur. Good morning and good to see you in. This is Nigel on this side. So you're sounding quite optimistic about the telco companies itself. But what are you factoring in? A duopoly, or do you think it'll be a three-player market?
I think, what we are seeing is, there is definitely a lot more investment by more players now than just the two leading players. And that might help, the market stay less than, or let me say, markets stay more fragmented, and incremental consolidation may not happen to the same extent it has happened in the past. If anything, one would have seen, if you look at the evolution of the level of market consolidation, if you look at, for example, the Herfindahl-Hirschman index, or the HHI index for India, it's been rising very rapidly in the last 5-6 years, but has slowed down a bit in the last couple of years, despite the fact that capex was extremely, consolidated, right? Just a few players were doing most of the capex. As that gets a bit more fragmented, as capex is spread out by other players also, I mean, not just the top two, but also including the SOE, I think the ability for the market structure to remain the way it is right now is higher, as opposed to market structure continue to consolidate going forward.
Right. On the telecom sector itself, just before we move on to other things, we had a lot of experts tell us that they're factoring in further 20-25% price hikes. Just wanted to know if there is enough demand to sustain this 20-25% sort of price hike over the next 18 months or so, because there has already been an increase, and we've seen a decline in the number of users, etc. as well. Just wanted to understand if there is enough consumer demand to be able to absorb that 20-25% price hike.
I think it's a very valid question. What we've seen so far this year, the level of tariff increases eventually was actually a bit below what we were expecting and what the market was expecting. We had previously factored in a tariff hike in the region of around 20-25%. I think the street had also baked that in earlier. Eventually, what we saw is the tariff hike was effectively around, mid to late teens, 15-17% for some of the incumbents, and 18-20% for one of the incumbents. So as a result of this, the tariff increase this time has been slightly lower than what people were expecting, maybe leaves a bit more room to take another tariff hike, maybe another 12 to 18 months from now. Secondly, also the tariff increases have been a bit more graded. It's not equal at the lower parts. If you look at, for example, the entry-level phones or the feature phones, the extent of tariff increases is a lot lower, which makes it easier to absorb at those parts. And the tariff increases sort of tend to go up a bit more when you look at the smartphone segment. And of course, on the 5G side, the entry-level tariffs have been taken up even more. So the graded tariff increases this time does leave some room for another tariff hike. What we've currently built in is another 10-15% tariff increase next year. We haven't built in tariff hikes after that. Now, in the context of pricing, if you look at the telecom spending as percentage of GDP, if you look at the ARPU value the pricing for data and in general, India remains among the much more, I would say, reasonably priced markets across the EM overall, and that gives you some space of increasing it a bit more. The churn, we've seen 1 month of churn, like you highlighted. The telcos which have taken a tariff increase have seen a churn in favor of the away from them, and the telco which has not taken any churn has done some capex recently, has gained some. So what we'll have to see is if this sustains, beyond 1 or 2 months, if the network quality is improving for the fourth telco also, in which case there could be potential risks of churn. But if it does not, because we've seen a lot of capex by the other guys, if the quality is not as good, some of this churn might actually come back. So we'll have to come and eventually see if the level of SIM consolidation, down trading, when the numbers come out for 2Q, is high enough to get worried about ability to take another tariff hike in the next 18 months.
Okay, all right. Ankur, I wanted your comment on this space, which is getting a lot of attention. Zomato has done very, very well, could potentially enter the Nifty as well. So the street is a buzz. And in the unlisted market, people are looking forward to Swiggy's IPO. How do you see the trade-off between the two and your view on this space?
Apologies, I will not be able to talk about any individual names. But what I would say is that we definitely like the food delivery and quick commerce space. We are definitely finding that quick commerce as a category is disrupting several retail channels, including modern trade and e-commerce. And as a result, the category will keep growing very, very sharply. Our recent research, we've highlighted that quick commerce operators have already become more than 50% of overall online grocery. The category expansion that is happening into newer categories beyond just food and grocery, into beauty and personal care, into electronics, appliances, toys, seasonal products is being very, very sharp and very strong. A much higher proportion of the gross order value or the order basket is expanding to these categories, which is not only increasing the average order values and hence improving profitability, but also increasing the use case for the category. So I think that we feel is a structural trend, and hence growth will continue to be very strong. On the food delivery side, growth has surprised us. We were expecting growth to slow down to mid to late teens by this year. It's continued to be at 30%, which was a big surprise. We think going forward now, food delivery growth can sustain about 20%, and that would be attractive. So what we find on the food delivery side, it's a bit more mature business, about 20% growth, but EBITDA margins can keep expanding because of operating leverage on indirect costs, whereas quick commerce will remain on disruptive, potentially exponential growth for a few years from now.
All right, so, an obvious follow-up on that is how much of the QCOM opportunity is already in the price for the leader? And does the leader have to worry about, strong competitors raising money at serious valuations every successive round? So while the opportunity is there is intense competition out here as well. So what does that mean for QCOM in particular? And for the leader here, food delivery QCOM leader here, there is that optionality of the going out business as well. Have you ascribed any sort of value to that?
Yeah, again, we'll not be able to make any comments about one specific company, but from a category overall perspective, the success of quick commerce, from the quick commerce, let's call it insurgence on the Indian retail landscape, right? There are 3 to 4 new companies which have built this category and which sort of taking share away from traditional modern trade, traditional e-commerce. They've obviously created much more scale, space in this. 90% market share is with them. The existing e-commerce players we feel they're probably threatened by this, and as a result of this, we are seeing potentially defensive launches by e-commerce companies to protect their turf to an extent, because a lot of the categories that they are very strong at, electronics, appliances, potentially are under threat. And hence, I think the next 1 year will be very interesting. There will be a lot more launches. There will be, I think, testing out of the product market fit of the approaches various companies are taking. I think there's a difference in the approach that many of the quick commerce companies are taking versus what the e-commerce companies are taking. And what will, I think, drive eventual success is who can deliver on the supply chain, who can deliver on the promise service level, SLAs on time, compliance on time, availability, price, and supply chain. I think that category, the people who do well on those metrics will eventually win the market, and as a result of this, I think this category will expand. And we also think that as more and more traditional players, whether it's modern trade or e-commerce, enter the category, it will expand the addressable market from a user perspective a lot faster. Any of the incumbent e-commerce leaders have many more DAUs, many more MAUs compared to any of the quick commerce guys. So if it attracts more people to the category, I think the category will benefit overall.
All right, final question before we let you go, Ankur. What about the IT pack? Have things bottomed out? Will things look up from here on? How are valuations placed? And also particularly a quick comment on the ER&D space, because, that theme has generated a lot of excitement and those stocks have gone through the roof.
Yes, so on IT services, what we've seen is demand perhaps bottomed out anything from 3 to 6 months ago. Most companies are seeing year-over-year growth momentum beginning to improve, although at a relatively slow pace. So, for example, fiscal 24 was low to mid-single digits growth for the industry and for the big companies, and mid to high single digits growth for the mid caps or smaller companies. This year, I think bigger companies, tier 1 companies, are moving from low to mid to slightly mid single digits kind of growth. So maybe an acceleration of 50 to 100 basis points, 150 basis points or so. And I think industry level will be probably broadly very similar. And we are still looking at going to about 6 to 8% growth for the industry in fiscal 26. So we are in that journey from going from very low growth towards more reasonable long-term average trend growth. Some of this is being driven by financial services spend recovery. In the last 2 quarters, at least in the June quarter, we saw a surprise on financial services spending by many of the players among the large companies and small companies. And that is one of the key areas where growth improvement will happen, because it's such a big end market for many of these companies. And I think that will be a driver of how strongly growth can recover next year. Among the large cap versus mid cap size, like I said, large cap growth will be recovering, perhaps at a slightly slower pace because they're exposed to the macro a lot more. Mid-sized companies are a bit more selective. Some companies exposed to financial services will see a recovery faster, but potentially. Also on the ER&D side, what we are seeing is growth has been relatively strong depending on your exposure. The auto ER&D companies have enjoyed very strong growth for the last several years. I think that there is room for that to extend. The companies with a more diversified portfolio have struggled to an extent in areas like aerospace and defense, in areas like TMT, which have been under pressure. And as and when that recovers, they should also see growth. Now, what we do believe is the growth opportunity in ER&D is more secular, stronger in the medium to long term than whether it is IT services, large cap or mid cap, and hence you see a difference in the performance of the stocks as a result. But I think that's what's driving the overall momentum. So we are overall, relatively positively biased on sections of the technology IT services ecosystem. We like companies on the larger cap side which provide potential for growth recovery and dividend support, and the strongest growth companies on the mid cap side.
All right. Thank you so much for joining in, Ankur. Always a pleasure speaking with you. Insights on a whole host of sectors, including telecom, quick commerce, e-commerce, as well as the IT space and ER&D. Take a short break, come back on the other side. We'll have Shivangi Sada, who joins in to give us a technical check on the market.